All right. Hello, everybody. We are officially live. Thank you all for being here. It is Tuesday, what is this today? Is it July 5th, 2022? Happy to see everybody here. It has been a while since we have opened up the stock market because, well, the stock market hasn't been open for a minute. So, okay, audio is going good. That's going good as well. Yeah, we're here. We're live. Let me tweet this. Let me put this up. It's been a while. I don't know how long it's been since the stock market was open. It's been like almost 5 days. And it's, yeah, live stock market open. I've missed you guys. I've also missed the markets. I can't believe I'm saying that. It's like, you know, you're looking at the markets. All right, so let's go into Webull. There's a little bit of... Let me get rid of this real quick. There's a little bit of interesting stuff that's happening right now with the markets. Bitcoin is teetering from 19K to 20K. It's been down from 20K for a while. SPY's down 1% pre-market, so it closed at 381 last week. Now it's at 376. So I mean, it did a decent close last week for the week that it did, but now it's backing down to normal to where it is right now, or to even to lower levels from last week. So we're there. Tesla Q2 deliveries. Tesla's also down pre-market about 1.85%. Tesla had 254,000 vehicles delivered, which is a pretty good number. It was not a bad number, but nonetheless, Wall Street is not the most impressed with it, especially in this market. This market is not the best for it. Morning, finally up early enough to catch a stream. Thank you, Dave, for being here. Yusuf, what's up? Felicia, back at mom's for breakfast. I still live here, Felicia. I just go back and forth because that's where I'm working. I'll give you guys some updates on what's been going on in my life as well. Market will be opening in about 1 minute, and so we're gonna open the bell. I have a cowbell for those who are new here. We have this bell, and this bell is what allows us to open the market together as a community, just like if we were on the NASDAQ stock exchange. That's the one thing, bro, that no other YouTuber does. You cannot say that any other... Wow, Coinbase at 48. Oh, boy, Coinbase. You cannot say any YouTuber opens the stock market with a cowbell every morning. There's just no way. We have to make a compilation one day of, like, all my stock market opens with the cowbell. I feel like that'd be pretty epic. Nvidia down to 141. Goodness gracious. Shopify, obviously a split, but it's still down 3% or 2% at 30 bucks. Facebook. Look, Facebook's the interesting one. Mark Zuckerberg over the weekend had a note to his employees that says, look, you either got to perform or get out because we can't tolerate mediocrity. And essentially said, if you don't want to be here, then that's fine with us. They are ready to fire people. They are ready to stop hiring people at strong levels because they just don't have the revenue at this point to support what's been going on. So Facebook's going to be an interesting case to see ultimately what happens. If the market gets this bad, Facebook and Apple both in the 110s, 120s would be absolutely insane. But, like, we will see what happens. All right. Are you guys ready? The stock market is officially open. Wake your ass up. The stock market in the United States of America at 9:30 a.m. Eastern is now open for business. Billions and billions of dollars will trade hands today, trying to understand which equities will go up and which ones will go down. Here we go. All right, let's go to some of our favorite stocks to start it off. Let's go to Palantir. Good morning, everybody who's in the chat. Palantir, what do we got? On Palantir? We've got 914. Okay. So it's down 1.46%. I think it closed last week at a little bit like 920, 930 or something. So nothing too crazy. 914. Coinbase opening up at 48. Obviously, Bitcoin has been decimated. It was doing well at 21,000 last week. I mean, it was itching up towards 25, all that stuff. But now it's just come right back down. So Coinbase is going to be suffering with it. SPY opens up down almost 2%, 375. So 362, I believe, was the low on the S&P 500 index. We're going to see if we get there again this week or what happens. Amazon has had the worst decline this quarter, almost 30%, that they've ever had in the history of their company. They are down at $106 adjusted for split. It's close to about $2,000 a share if you do the split. Tesla, $665, opens right under $670. Tesla, again, Q2 earnings or Q2 deliveries were not bad. I think Q2 earnings are just not going to be phenomenal. And in this market, given the macroeconomic dynamics, if earnings aren't good, then the macro is bad. What the market's also looking for is they're looking for earnings to be bad, to kind of like, they want psychological validation that what's going on is not incongruent with, wow, I haven't used that word in a long time, incongruent with the earnings, right? Because if earnings are phenomenal and the macro sucks, the market's really going to be like destabilized. And be like, well, these companies are doing great. Like imagine Robinhood does $4 billion in revenue or some nonsense, right? It can't be a $7.87. I mean, like it doesn't make any sense. So the market might have to buy, but the market's also like, well, we don't want to buy because of interest rates. So if earnings suck, the market also is kind of like, well, that's good, because if earnings suck, it justifies our sell-off. We can tell our clients, our portfolio managers, that there's no reason to hold these stocks. We can actively manage the fund for them in a way that doesn't seem like we're idiots, because we're looking at basic numbers, and basic numbers are saying these companies aren't growing as much as they should be, which will theoretically induce the recession. I mean, that's just going to happen when we do that much selling off. But that might be the only way to get out of it. That's what we have to see. Showcat, shout out to you. Hey, watching on my new TV at my new place. Appreciate you, bro. I hope you enjoy the new place. I need Palantir back under 7. I wasn't done buying. I agree with you. I was not done buying my Palantir at all as well. So that's that. We have NVIDIA 140, AMD. Let's go to CNBC and see some of their highlights. What are they talking about? First of all, let's go to the website. CNBC. Dow falls more than 400 points as Wall Street grapples with recession fears. Yeah, I mean, that's like the reason that's the main story and nothing else is because like that's what Wall Street is grappling with. Recession fears. We are like, there's really no other big stories. Do you see it? Like, there's nothing crazy. Let's look at this Ford. I don't know if this is Ford earnings or this is U.S. sales. Ford on Tuesday reported a 1.8% uptick in second quarter sales compared to a year earlier, including a 31% increase in June. Analysts expect the Detroit automaker second quarter to increase between 3. Okay. So, nothing crazy for Ford, but obviously nothing enough to get rid of recession fears. Notably, Ford sales of F-Series pickups improved to 57,000 units. Yeah, I mean, nothing crazy. The number one picture, Dow falls more than 400 points as Wall Street grapples with recession fears. Recessions are most accurately characterized by a meltdown in employment accompanied by an inability of consumers and businesses to meet their financial obligations. This would be demand destruction with less jobs and more people, trying to find a way to pay for things. While we are currently experiencing a meaningful slowdown in economic growth from extremely high levels, neither of the above conditions are present today. That's interesting. In the shortened holiday week, investors are looking ahead of the release of the June jobs data report on Friday. According to Dow Jones estimates, job growth likely slowed down with 250,000 non-farm payrolls added, down from 390,000 in May. Economists surveyed expected the unemployment rate to hold at 3.6%. That's the other crazy thing about this market. Like, when we had COVID, the market unemployment rate was almost 15%. It was some ridiculous number. Great Depression was 25%, right? So we're at 3.6% unemployment. Like, at one point, you got to ask yourself, like, what exactly is this? What's exactly going on? What's for breakfast pain? Yeah. If you believe that high inflation will be a thing for the next 6 to 12 months, you have plenty of buying opportunity over time. I agree. If you think inflation is not going down, which, they say it's 8.6%, but we all know it's probably a lot more than that, then there's going to be a lot of work to be able to get it to go down. We're going to look at Bill Ackman's tweets as well, but what I was saying is the market, like, if unemployment is only 3.6%, it would have to substantially increase to also be congruent with the concept of the stock market falling as much as it has, which would lead to like an overall thesis that there is a recession. But that overall thesis isn't really like present. I don't know, simply because it doesn't feel like it's happened. Or it doesn't feel like it is happening to that extent. But if people start losing their jobs, then it's like, all right, then we've got a much bigger chance for it. All right, Bill Ackman, let's go through his biggest tweet that he pinned yesterday. There's a lot to talk here. Let's see what he's saying. Over the past 2 weeks, rates have declined dramatically, purportedly due to fears of recession. Friday's move was particularly stunning for the scale of the move and the degree of intraday volatility. I put forth a theory of what is going on. On the risk of a recession is defined as a 2-quarter decline in real as opposed to nominal GDP. In a highly inflationary economy, it is more difficult for nominal spending and growth to exceed inflation. In order, therefore, for today's economy to grow on a real basis, nominal GDP must be more than 8.6%, right? Because 8.6% inflation, so we have to have more output than we're having in terms of the taking away the value of the actual dollar itself. Excited for June CPI data? Yeah, I am very excited to see that as well, which is a difficult hurdle to exceed. It has been 40 years since we have experienced inflation at current levels, and as a result, market participants are used to a world with 4 to 5% nominal GDP growth with 2% inflation, with inflation at 2%. Nominal GDP growth need only decline 4 to 5% to less than 2 to 3% for 2 quarters in a row for real GDP to be negative, which is the key here, and for the economy to be deemed in a recession. 2 quarters of negative GDP growth does not, however, seem to be a reasonable definition during a period with high inflation. So he's saying we should sort of challenge the conventional way we think of how we think of a recession, given the exponential, not exponential, but like really strong levels of inflation that maybe one day could be exponential. That would be really bad. But that's bad, right? So when we have 2% inflation, nominal GDP going down by being negative for 2 quarters in a row makes sense to define a recession. But the premise of that has changed, particularly when inflation has spiked to nearly 9%. Nominal spending growth of 8% for the last 2 quarters would technically put us in a recession, but this does not make sense fundamentally. So he's challenging the idea of being in a recession given this type of inflation. The economies continue to grow rapidly on a nominal basis. Consumers are spending substantially more this year than last. There are about 2 times as many job openings than people looking for work. This is what I was talking about above in terms of unemployment being 3%. It's at a 50-year low. Wages are rising substantially, and it's hard to find workers. Q2 revenues and earnings growth should be strong for most businesses. So he's assuming that earnings is not going to be bad, which is going to put the recession, or going to put the market in a very conflicting situation. Because if earnings are good and the macro sucks, the market's going to be like, how do we give the premiums or the multiples that we want to give to these companies? If earnings are bad, it makes their job a lot more easier. With earnings misses and margin declines for some companies which have limited pricing power. Consumers have approximately $2.5 trillion of excess savings. While there is a mix shift underway from goods to services, overall demand is extremely strong. We have a supply, not a demand problem. This does not seem like a setup for true economic recession, regardless of the favored definition. So why have rates declined so dramatically, particularly short rates, when the Federal Reserve has become increasingly strident about the need for aggressive tightening to bring inflation down to 2%? It's kind of disagreeing with Kathy, because Kathy's argument is based on consumer demand reports from University of Michigan, that demand is going down, and that demand isn't as good as it should be. The answer, I believe, is largely due to some misunderstanding about what a recession is, but more importantly, technical factors that are driving volatility and the downward move in rates. Market participants speculating the fixed income market, particularly hedge funds, often use enormous amounts of leverage because it is available and allows one to make windfall profits if you get the trade right. Meaning, if you bet $2 billion that a stock is going down, you make a lot of money. If you have a long call, it's going up, right? So they play with a lot of money. The bet that rates would rise became one of the more crowded trades in history in going down to June 15, which means people were betting on how the market would react if rates go up or down. As speculators covered their shorts on the Fed news, rates began to decline, causing substantial mark-to-market losses, particularly for levered participants who were forced to choose to cover, which means, they have to cover their positions or else they're going to lose more money. With more data points emerging indicating a slow economy, the recession narrative took hold, causing a further decline in rates, contributing to more losses, short covering, going to the quarter when exposures are required to be disclosed in investor reports and financial statements. That was at the end of Q1, basically saying this whole narrative and perception of a recession started to happen based upon all of these extenuating circumstances. Which, Bill, to be quite frank, you also put out into the world, because there was a couple threads back in March of you saying we need to start World War III and we also need to raise interest rates dramatically. So it's a little bit of a switch from Bill. Extremely limited liquidity going into the July 4th holiday compounded the move and the volatility and the pain for levered market participants, as traders looked to and in many cases were forced to exit or didn't wish to hold open positions. So what happens from here? Powell is committed to doing whatever it takes to quell inflation, even if doing so causes an increase in unemployment and a recession. Inflation is not coming down soon. Housing and rental costs, energy, food are all constrained by higher prices and are unlikely to be able to be abate for the foreseeable future. Wages are continuing to rise as immigration has been limited. Many have exited the workforce and the balance of power has gone from companies to their labor forces. This is the Great Resignation. Companies are raising prices because they must in order to cover their costs and because they can, because they have pricing power. The wage price spiral is underway, meaning the more your price wages go, if you make $7, now you make $8, that burger that you were paying $3 for costs $4. So the nominal purchasing power of the extra dollar you get per hour doesn't really exist at that point if you have a wage price spiral. While demand is moderating due to the sticker shock and inflation as well as rising rates, overall demand remains strong. Inflation has become embedded in as a daily experience, headline news, and a dinner topic for us all. Saving bonds pay 9.62%. In order to stop the inflationary spiral, the Fed will need to rapidly raise rates to 4 to 5% by next year, which hopefully will be enough to snuff inflation. The mild and transitory inflation began priced by the market as of Friday is a fiction, meaning the market saying, oh, it's okay, inflation will get back to normal. We have 75 basis points. Bill is saying that's not going to happen. Rates are going up a lot soon. The sooner the Fed quells inflation, the better for long-term bonds and long-term financial assets like equities. Don't be misled by short-term, technically driven market movements. This is what we call dead cat bounces. Stocks of high-quality businesses with long-term growth and pricing power look cheap. Don't forget that the stock market measures nominal business value. Inflation is hurting businesses and consumer confidence and slowing growth. Killing off inflation will save the economy in the long term at the expense of the short-term pain. Sort of telling the Fed, hey, you need to raise rates ASAP. Let's hope the Fed gets it right. I welcome your input and rebuttals, and yes, we put our money where our mouth is. I have often wondered why investors who share their views are often criticized for holding investments on which they will profit. This is the shorting the market, COVID stuff he's talking about. We are 100% long, high-quality growth businesses with pricing power and own hedges on which we will profit if rates rise. Our position as always matches our thinking and stated views. So he's basically saying, if they believe Facebook's a good high growth stock over time, they're 100% long, but they have some hedges shorting if rates rise, because they know if rates rise, then the value of tech stocks and high growth quality businesses are going to go down. And notice he said high quality growth, not value, not Home Depot, not Coca-Cola. He's talking about, the potential Googles of the world, Amazon of the world, Nvidias of the world, et cetera, et cetera. So Ackman's whole thesis here is, look, we need to get rid of inflation, and the only way to get rid of inflation is if the Fed does something immediately. I would tend to agree with that. The question is just how quickly is the Fed going to do it, and if they do it quickly, is that going to genuinely create a recession and destroy demand? And ultimately, we're going to see if that happens. But I mean, the core of his position is that we need to get rid of inflation. Now, the other thing about earnings is it's going to be really interesting. I mean, I'm going to be excited to see, like, Palantir earnings. What numbers do we put up? We said 470 million in revenue. Can we beat that? 475, 480? Do we come in below 465? If we come in lower, this baby is dropping. If we come in, at expectations, we're probably still going to drop. I mean, it's not, especially if the operating margins aren't phenomenal. And if we go in higher, like really good, we might get a penny on the share price, to be honest. That's why even looking at a lot of these prices, it's so funny, because it's like none of this stuff makes any sense or can make any sense until inflation goes down. Like like the market doesn't know how to value this stuff. For traders, it's a golden era because they're seeing stuff go up and down and up and down, and they're just playing with it, and they can time it decently well given some Fed announcements. But for long-term holders, it's like DCA and then just go away. There's nothing much more to sort of analyze there from that perspective. Apple at 137, Google at 2100, Twitter 37. Twitter's still holding up at 37. I mean, Elon Musk is the only thing holding it above 30, to be honest. Bill Ackman followed the chicken genius play on Tesla, LOL, long and short. Yeah, that is true, Theo. That is true. Crude and Brent oil is down by 5%. That's good. Yeah, oil going down has been very interesting. I've seen my gas prices go from, at least in New Jersey, $4.93 to $4.75. So I've seen some places at $4.40, $4.50, $4.60. So I have seen, now this may be very short term. This may all come back out of nowhere. But it's been nice to at least see some of it go down, and ultimately we're going to see how it happens long term. Can you check the price of oil? Yeah, let's do that. Brent oil price. Brent oil's at 107, which is down below from like 120 and stuff like that. Let's type in WTI oil, crude oil. WTI 102. So Brents are at 107 and WTI is at 102, which is, look, it's already down 5%. I mean, where were we? Let's do 6 months. The highest we got to was 124 on June 3rd, 2022. And then on Brent, the highest we got to was 139, it looks like. Let's see this. No, it was 127 roundabout. Yeah, 127. We got back to the 120. Yeah, 127 in March, and then 120 over the past couple of days, a couple of weeks. So we got from the 120s and high 120s back down to the low 100s. Now, remember, oil used to be 70 to 80. So, I mean, it's definitely not as good as it should be, but still. All about the green. Thank you for the super chat. Thoughts on Palantir losing ICE contract this November? Yeah, it's interesting. I don't think they're losing the entire thing. It's becoming a more multi-vendor sourced contract. And ICE and Palantir is working with some parts of the Homeland Security, and they're working with other parts of other companies. But in general, the reason I think it's positive is because we lose the negative stigma, which is great. So to be honest, if they decide, hey, we just don't want to work with you guys, either because we find some practices questionable or we just don't want to continue doing this certain thing, I mean, I think that at the end of the day, that just helps them. Now, I have to go a little bit deeper into the deal, but I would argue it's a good thing. Like, to get that, sometimes you just don't want some deals on your thing. Now, Palantir doesn't shy away from that stuff, right? So that's why I said, because it's becoming more multi-vendor oriented, it's not necessarily their decision to leave. But I will have to do some more reading up on that and try to figure it out. I've noticed that growth seems to be mellowed out a lot in higher lows at every pullback. That's a pretty big sign that the market bottomed. There's still pain left in the indexes, though. Yeah, so what Glitch Life is saying is, like, every time we have a low, there's a higher low in the bottom, which is showing us that we're getting to a bottom, right? Because if we, it's the same question from a technical perspective. How much lower can something go, right? How oversold is something? Like, at what point does Open Door become $1? You know, when it's trading below net book value, like, you got to really ask yourself, how much more can it go? And, like, you can always say stocks go lower, 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 yes, but at one point you have to ask yourself how much. Now, the indices can go lower. Even from a technical perspective, the S&P can drop a lot more lower than where it is right now. Again, JP Morgan estimates 340 on the S&P. Again, 417 we were at just May 31st. We had this big drop right here from 415 down to 362. That was within the time span of about 10 days. From June 7th to June 17th, that was the rough time. Then we bounced all the way up to 393. This I did not believe for 1 second, and now we're here. And now we might go back to 362, 350, 340. We'll see. Earnings are going to be a big play in letting us know what happens. Ever since Amit joined, the stock market has been crashing. Yeah, guys, ever since I started my YouTube career, the stock market has just been abysmal. So it's my fault. I'm sorry for ruining the stock market for you guys. Palantir didn't lose the ICE contract. They're upgrading to a new Palantir system. That's what I thought. See, I didn't get to read the article. I saw like a couple of headlines. Let me read the article. I will get back to you guys on that tomorrow. I really, honestly, it's been busy. I moved into a new place. It's been pretty busy. So let me get into that. I didn't think they lost it. I thought it was a different way of how they were doing the contract. But I'll talk about it. Bro, we can hear your fan from the PC or something. Yeah, that is because this mic stand is off today, and that's why the mic was way too close to the fan. Now I'm holding it right now, so it's probably you're not gonna hear it. But I'll be fixing that tonight. All right, guys, I got to be out today. I got to get going. Thank you guys so much for joining me on the Market Open. I will be here tomorrow. Not a lot of crazy news today, to be honest. Everything's been pretty boring other than the fact that the Fed, I mean, people think there's a recession. I mean, Bill Ackman was the most interesting news for today because, like, we're waiting on earnings. We're waiting on CPI data. We're waiting on jobs report, which will be coming out, I think, jobs report this week on Friday. And we're just waiting to see how the market is going to stabilize these stocks that they think are good, like Tesla, but that maybe not growing as crazy as they were before, or that are growing as crazy as they are, but don't know how to price in the macro. So ultimately, we're going to see. Are you mining Bitcoin? No, I'm not mining Bitcoin. All right, guys. Thank you so much. I will see you guys on the next live stream tomorrow at 9:20 a.m. Eastern. I'll see you then. Bye-bye.